The precious metals are being driven lower by automated spec selling into a dollar index that's just hit 2002 highs and a 24-year high.
Hey, Andrew, the last episode, you drew our attention to the broken silver market, and it sure looks like things have gotten completely out of control. Can you update us on what specifically is happening in these crazy silver markets here?
Yeah, Shane, I knew this would be one for you too, my friend. Let's start at the beginning. It's always the best place. Look, this has been proved to be a very tough holiday thinned 3 weeks. Now, if you remember from the 15th we did our last episode on the 24th of August, but we were already into a week of holiday thin market. We've made reference to it, but essentially, liquidity evaporates. You know what? I can move a market. Anybody could probably move the market at the right time of day. It is that we're talking about really thin, and of course that gives the momentum guys an advantage, and especially when you see a strong dollar. So what we saw is in this last 3 weeks, the precious metals are being driven lower by automated spec selling into a dollar index that's just hit 2002 highs and a 24-year high today against the yen. I mean, this is mind-blowing stuff. And but the thing is, to put that 20-year dollar index high into context, the last time the dollar index hit June 2002 highs or levels, gold was trading at $315 an ounce. So put that into more accurate terms, it now takes $1,400 more debased printed dollars to buy the same ounce of bought and paid for physical gold. That's the way to look at it. And when people say to me, isn't gold volatile? Just take a look at that. And very short term, the inversely linked spec algorithms that tick for tick sell gold and silver against this rising dollar index, what this actually illustrates is that in the bigger picture, the so-called safe haven demand chasing the dollar, because that's one of the reasons why the dollar is rising. When this safe haven demand that is supposedly chasing the dollar against all the other unpacked fiat currencies is also attracted to zero counterparty risk, safe haven physical gold and silver. So, but to really best illustrate just where we are in the war, this war that we've been tracking, as you know, Shane, between the spinning out of control, synthetic, undeliverable, short-term futures-driven pricing inputs versus really an increasingly divergent, unleveraged physical gold market. Obviously, leverage against unleveraged, obviously, it creates volatility. But we'll start this week's episode really by looking at the detail and then what to expect also for gold and silver, of course, into the close of this third quarter. We're in September now. So to best do this, we need to focus on the broken silver market, as silver is about to break out and it will lead the way higher for gold. So this is an important episode. Now, as you know, Shane, one of our objectives here at Live from the Vault is for us to continue to draw attention to the institutionals that follow us and how, from a wholesale market perspective, that the futures-driven silver market is completely broken, but ripe for the picking. And obviously, this is an educational program, but sometimes the silver market is missed. We'll look at that as in a little bit more. But really, right now, following 3 weeks of very thin liquidity, market liquidity, which has really better enabled the muscle memory speculators, blind completely to the wholesale market disconnect, to on really relatively low volumes, to naked sell silver into every rally. Now, this is the point. They are naked short. We know this to be the case because every single long speculator that got on board back in June 2020 at the commencement of the very large spike rally with no retracements until the 29s, that rally started at 17.5. Well, where did we go? It was a gap close. They were rinsed out last week exactly into that gap close, leaving every single automated spec sell order now as naked short with the house long against them. It's important to know this. So when people start thinking of selling. However, into this process, the resulting unprecedented backwardations, you remember, a backwardation is nothing but a futures price that is actually lower than the real cash price. So these unprecedented backwardations between the silver futures and the deliverable markets are so broken, they need to be reset before silver attracts the sharks and goes nickel. Now, silver provides the best illustration of just how disconnected all, and I don't mean some, all the US-centric paper-driven COMEX futures markets have become versus the real deliverable global physical markets. Now, this is evident in all deliverables, from metals through energy to oil. I mean, but out of all the physically deliverable asset classes, silver clearly is disconnected from the pack by an absolute mile. So to avert this extremely offside silver derivative market blowing up and going nickel in the 10 times larger over-the-counter markets, the broken, highly leveraged silver futures markets will be forced to rebalance. Now, there's a tidal wave of which we call at-the-margin physical market liquidity that has to be underpinned by the paper game. And but this liquidity is exiting the casino. And you see it, we see it, and most certainly the stackers see it. But spec sellers are oblivious, there's no other word for it, to the fact that this well is actually drying up.